Hello folks, this is Naeem Aslam, Chief Market Analyst at AvaTrade. Welcome to our fundamental analysis video. So let's begin once again where we left off with the fiscal policy. Now both Democrats and Republicans have finally agreed on that $2 trillion worth of fiscal package, which is going to soften, or which is aimed to soften the blow from coronavirus. And of course its influence on the US economy. Now, because of that agreement, which happened this morning, we are seeing some positive momentum in the equity markets. However, that momentum isn't that strong or sturdy as it was yesterday. Why? Because the Dow Jones Index surged over 11% yesterday, something which we haven't witnessed since 1933. That was the pace or the magnitude of the surge of the Dow Jones Index that we experienced yesterday. Of course, many are still asking this fundamental question that if that was a dead cat bounce or if the bottom is in place. My view is, let's go and then let's dissect the fund flows, the money flows with respect to bigger ETFs such as Vanguard, such as SPDR ETF for the S&P 500. And when I look at the estimated money flow, I do not see any sort of evidence, any sort of a huge evidence in terms of a money inflow in the equity markets. Now, the lack of this particular evidence leads me to believe that the current bounce in the equity market could be because of two major reasons. A is investors are somewhat optimistic because of the cohesive response on the monetary and the fiscal policy front. B, the magnitude of the sell-off was so intense that perhaps there aren't many sellers left in the market, and hence we saw this upward surge in the equity market. But we are nowhere close to forming a bottom. Why? The economic numbers, and I'm speaking of global economic numbers, not specifically Eurozone, Asia or the US, they are still going to print very immensely dire reading. So that major fundamental or the narrative hasn't changed. We still yet have to see the surge in the coronavirus outbreak over in the UK and also in Europe as well. Yes, we've started to see some curtail of the outbreak of virus in Milan, but the death ratio, unfortunately, is still enormously high. And that still hasn't reached its peak. The only place where we are somewhat optimistic with respect to the outbreak is China. Yes, over there are evidence that people are returning. And of course, Apple, speaking of opening some of its stores, possibly in April, is also a positive news. So I think what we really got to look at, again, going back to the basics when it comes to fundamentals, fiscal policy, monetary policy support, checkbox. B, coronavirus outbreak curtailing around the globe, cross. Economic numbers are not impacting the equity markets anymore, cross. We're still going to see the major impact on that, and because of that, because of the dire numbers which are about to come. So I think, and more importantly, we haven't seen the impact of the actual earnings season. Yes, the FCA has asked for in the UK for companies to delay that, but the situation isn't the same when it comes to the US. So I think if investors continue to focus on these ones, it would be wise to look at the picture more clear. And of course, headlines such as yesterday, where the equity markets have surged to a level that we haven't seen, the daily surge was more than something we haven't seen since 1933, is further eluding their thinking process. It further clouds their decision-making process. And that is why it is absolutely necessary for us to filter all the noise and pay attention to the fundamentals and keep an eye on the ball. That's all for today. See you guys tomorrow.